Welcome back to the deep dive. Today we're tackling a real classic in the investing world.
Oh, yeah.
Benjamin Graham's The Intelligent Investor.
Mhm.
We're diving deep into chapter 15,
Right.
which is all about picking stocks.
Right.
We've got excerpts from the chapter you provided,
Yeah.
and we're going to break it all down.
So good.
This chapter is for what Graham calls the enterprising investor.
That's right.
That's someone who wants to be a bit more hands-on with their portfolio
Yeah.
and maybe even try to outperform the market.
Which, as Graham points out,
Yeah.
right from the beginning,
Mm-hmm.
is a pretty tough thing to do.
It is.
He even says that beating the market consistently is really difficult, even for the professionals.
Why is that?
Well, he actually uses a really interesting analogy.
Okay.
He compares security analysts,
Mm-hmm.
the people who spend their days poring over company data
Right.
and making investment recommendations,
Okay.
to bridge players at a tournament with so many experts analyzing the same information.
Yeah.
Sometimes the winners might just be lucky,
Oh.
not necessarily more skilled.
So it's not as simple as just finding the smartest analyst and following their picks.
Exactly.
Okay.
What Graham is getting at is that the market is complex.
Right.
There are so many factors that influence stock prices
Mm-hmm.
that it's incredibly difficult to predict which stocks will outperform.
Yeah, that's true.
But he doesn't suggest giving up altogether.
Okay.
Instead, he challenges some common myths about stock picking,
Okay.
like the idea that simply focusing on industries with high growth guarantees success.
This makes me think of all those tech companies that were soaring a couple of years ago.
Right.
Not all of them have kept up that momentum.
That's a great example.
Yeah.
Growth is important, of course.
Sure.
But Graham emphasizes that it's not the only thing that matters.
Mm-hmm.
He warns against buying into so-called hot stocks at any price,
Right.
reminding us that value is always a key factor.
So how does Graham suggest going about finding those valuable stocks?
Well,
He does share a glimpse into his own firm's playbook, right?
he does.
Okay.
He talks about the strategies
Okay.
that his firm, Graham Newman Corporation,
Mm-hmm.
used to achieve success.
All right.
One of those strategies was called arbitrages.
Okay.
This involved capitalizing on temporary price discrepancies
Okay.
between stocks,
Mm-hmm.
particularly during mergers or acquisitions.
It was all
For example, let's say Company A is acquiring Company B.
okay.
Sometimes during that process, there might be a slight difference in how the two stocks are valued.
Okay.
Graham Newman would try to exploit those differences to make a profit.
Interesting.
Yeah.
And what about those net current asset issues or bargain issues he mentions?
Right.
What's that all about?
This is one of Graham's core strategies,
Okay.
and it's all about finding those hidden gems,
Right.
companies that are trading
Uh-huh.
for less than their net current asset value.
Okay.
To understand this, imagine a company decided to liquidate all its assets.
Okay.
The cash they have on hand,
Mm-hmm.
the inventory they have in their warehouses,
Right.
everything they own.
Right.
Then they subtract all their debts.
All right.
What's left over is their net current asset value.
So it's like figuring out what a company is really worth if they were to sell everything off today.
Exactly.
Okay.
And Graham's point is that sometimes, due to various market factors,
Mm-hmm.
a company's stock price can drop
Yeah.
below this net current asset value.
Interesting.
He saw this as an opportunity to buy a dollar for, say, 50 cents.
Oh, wow.
Of course, not every company trading below its net current asset value is a good investment,
Right.
but it's a starting point
Okay.
for finding those potentially undervalued companies.
Makes sense.
Yeah.
He's looking for those situations where the market is undervaluing a company,
Yeah,
almost like finding a mispriced item at a store.
exactly.
But if we're trying to follow in Graham's footsteps,
Yeah.
where do we even begin to find this information?
Well,
He does mention a certain tool, right?
it does.
Okay.
Graham surprisingly points to a fairly simple resource,
Okay.
the Standard & Poor's Stock Guide.
Okay.
This guide provides key financial data
Mhm.
on a wide range of companies.
Right.
And Graham walks the reader through a step-by-step process for using it
Okay.
to identify potentially undervalued stocks.
So it's like a treasure map
Mm.
for value investors.
That's a great way to put it.
Right. I like it.
He even lays out 6 specific criteria
Okay.
to look for when filtering through the stock guide,
All right.
including things like a company's financial condition,
Mm-hmm.
their earnings stability,
Okay.
whether they pay dividends and how
Yeah.
much their earnings have grown.
Yeah.
He's essentially giving us a framework to start our research.
This is fascinating stuff.
Yeah.
But then he does something interesting. He talks about his own experiments
Right.
using just one of these criteria to pick stocks right.
Right.
What was he trying to figure out?
Graham wanted to see if simply focusing on one single factor,
Okay.
like a low price-to-earnings ratio
Mm-hmm.
or a high dividend yield,
Right.
was enough to outperform the market.
Interesting.
And what he found is that these single-factor portfolios often underperformed.
So trying to find that one magic bullet to stock picking doesn't really work.
It seems that way.
Okay.
Graham's experiments really highlight the importance of diversification
Yeah,
and using a combination of criteria when evaluating a stock.
that makes sense.
Yeah.
This is all making a lot of sense.
Good.
But I'm curious to hear more about some of his specific examples
Yeah.
and how these strategies played out in the real world.
Well, there's a lot more to unpack in Chapter 15.
Okay.
We'll get into those details in the next part of our deep dive.
All right, sounds good. All right, we're back and ready to dig deeper into Chapter 15 of The Intelligent Investor.
Okay.
Before the break, we
Yeah.
were talking about Graham's emphasis on value
Mm-hmm.
and his strategy of looking for net current asset stocks. Those companies trading for less than the sum of their parts.
Right.
I'm really curious to hear more about how this strategy actually worked for him.
Well, what's fascinating is that Graham tracked this strategy's performance
Okay.
for over 30 years,
Wow.
from the roaring 20s
Hmm.
through the 50s.
Okay.
And guess what?
What?
It consistently outperformed the market,
Wow.
with the exception of the really tumultuous period of the Great Depression.
So even through all those market ups and downs,
Yeah.
the strategy held up pretty well.
It did.
That's impressive.
Yeah.
But wasn't he writing this book in the early 70s?
No.
Did he think this approach was still relevant then?
He actually suggests that it might still be a viable strategy,
Oh.
even as the market landscape was changing.
Mm-hmm.
But he also emphasizes the importance of thorough research.
Okay.
He wouldn't just blindly buy any stock trading below its net current asset value.
Right.
He'd dig deeper into the company's financials,
Uh-huh.
look at their management team, and really try to understand their business.
So it's not just about finding a cheap stock.
Right.
It's about understanding why it's cheap
Right.
and whether there's a good reason to believe it's undervalued by the market.
Exactly.
Okay.
And this leads to another point that Graham makes, which I find really intriguing.
Okay.
The idea that the market can sometimes be irrational.
Oh, you mean how stock prices can go up and down based on emotion and speculation?
Yeah.
Not always reflecting a company's true worth?
Precisely.
Interesting.
He gives examples of well-known, solid companies
Mm-hmm.
with household names
Okay.
that were trading at ridiculously low prices,
Wow.
while other companies,
Yeah.
often with less impressive track records,
Right.
were soaring to crazy valuations.
That seems like a real opportunity for a patient investor
It is.
who's willing to do their homework,
Yeah.
but it also sounds a bit nerve-wracking.
Well,
What if you buy one of those bargain stocks
Mhm.
and it just keeps dropping?
Well, that's where diversification comes in. Graham repeatedly emphasizes the importance of not putting all your eggs in one basket.
Right.
By spreading your investments across a variety of companies and industries,
Yeah.
you can reduce the impact of any single stock performing poorly.
So even if you misjudge one or two companies,
Yeah.
the other stronger investments can help balance things out.
That's the idea.
Okay.
It's about managing risk.
Mm-hmm.
Now, to illustrate this point about bargain hunting,
Okay.
Graham shares a really interesting example.
Right.
The Burton-Dixie Corporation.
Okay.
This company was trading significantly below its net current asset value
Mm-hmm.
and its book value,
Okay.
which is another measure of a company's worth.
So the market was essentially saying this company wasn't worth as much as its assets suggested.
Right.
Interesting.
And while it took a few years,
Okay.
Burton-Dixie was eventually acquired by another company
Oh, wow.
at a price much closer to its book value.
Oh.
This means those investors who saw the value that the market was missing and were patient enough to hold on were rewarded quite handsomely.
That's a great example of how this strategy can play out.
It is.
Okay, so
Yeah.
we've talked about value investing and
Mhm.
finding those bargain stocks.
Yeah.
What else does Graham cover in this chapter that we should know about?
Well, he also delves into what he calls special situations,
Okay.
which are essentially investments
Mm-hmm.
in companies going through big changes.
All right.
like
Yeah.
mergers,
Okay.
acquisitions, or even liquidations.
This sounds a bit more complex and maybe even risky.
It can be.
Is this something the average investor should be trying to do?
That's a great question.
Yeah.
And Graham is actually very upfront about the fact that special situations can be tricky.
Okay.
He even cautions that they're probably best suited
Yeah.
for experienced professionals.
So why are they so complicated?
Well,
What makes them different from the other strategies we've discussed?
for one thing, special situations
Yeah.
often involve a lot of moving parts and uncertainties.
Like what?
Let's take a merger as an example.
Okay.
You have two companies coming together,
Right.
and there are all sorts of factors that can impact the final outcome. Things like antitrust regulations,
Okay.
shareholder approvals, and even unexpected changes in the market.
It sounds like trying to predict the ending of a movie before you've even seen the middle.
That's a great analogy.
Yeah.
And to illustrate these complexities,
Okay.
Graham walks through 3 real-world examples
Right.
of special situations,
Okay.
starting with the attempted acquisition of Kaiser Roth,
Kaiser.
a clothing company,
Okay.
by Borden, a much larger food and dairy company.
That's an interesting combination.
It is.
Did it work out?
Well, when Borden made its offer,
Yeah.
their stock price
Uh-huh.
represented a significant premium
Okay.
to Kaiser Roth's stock price.
All right.
This created a potential opportunity for investors to make a profit by buying Kaiser Roth stock
Right.
and simultaneously selling Borden stock,
Interesting.
betting that the merger would go through
Okay.
and the prices would eventually even out.
So they were trying to profit from that price difference between the two companies.
Right.
But you mentioned it was an attempted acquisition?
Yeah.
Did something go wrong?
Yes.
Oh, no.
In this case, the Kaiser Roth board of directors actually rejected Borden's offer.
Oh, wow.
So anyone who had placed that arbitrage bet
Right.
would have been in a tough spot,
Yeah.
potentially facing a loss.
Wow. That's a good reminder that even when things seem like a sure thing,
Right.
there's always a chance that a deal can fall apart.
There is.
What about the other examples?
Well,
Did they have happier endings?
one of them did.
Okay.
Graham also talks about National Biscuit Company,
Okay.
which you probably know is Nabisco,
Nabisco, yeah.
the maker of Oreo cookies.
Oh, yeah.
They made a bid to acquire Aurora Plastics.
So from cookies to plastics? That's quite a leap.
It is.
Does the market think it was a good idea?
It seems there was some skepticism.
Okay.
Aurora Plastics stock was trading well below Nabisco's offer price,
Interesting.
which suggests investors weren't convinced the deal would be completed.
So another potential arbitrage opportunity,
Right.
but with a lot of uncertainty.
Yeah.
Did this one pan out?
It did eventually go through,
Okay.
although at a slightly lower price than initially offered.
Okay.
Still, those investors who saw the potential
Mm-hmm.
and bought Aurora Plastics at that lower price
Yeah.
would have made a nice profit.
It seems like these special situations require a lot of research
Definitely.
and an ability to assess risk. What was the third example Graham discussed?
The final example
Okay.
involved a company called Universal Marion.
Universal Marion.
This wasn't a merger or acquisition,
Okay.
but rather a company that was winding down its business
Mm.
and liquidating its assets.
So instead of two companies becoming one, this was a company essentially ceasing to exist.
Right.
What was the investment opportunity there?
Well, Universal Marion estimated
Okay.
that its stock had a certain book value per share
Uh-huh.
based on its remaining assets.
All right.
But surprise, surprise,
Yeah.
the stock was trading for significantly less than that.
Really?
This suggested investors weren't confident
Okay.
they'd receive the full value
Right.
during the liquidation process.
So another potential bargain
Yeah,
for those willing to take the risk.
exactly.
Okay.
But as Graham points out,
Mm-hmm.
even in a situation like this,
Yeah.
the final outcome is rarely certain.
Right.
There could be unexpected costs,
Okay.
delays,
Nah.
or other complications
Yeah.
that can impact how much value is ultimately returned to shareholders.
These examples are fascinating and really illustrate the complexities of special situations.
They do.
It sounds like Graham is suggesting that unless you have a deep understanding of these kinds of deals and are comfortable with a higher level of risk, it might be best to stick to more straightforward investment approaches.
That's a good takeaway.
Yeah.
He's definitely advocating for caution
Okay.
and careful consideration in this area.
So we've covered a lot of ground,
We have.
from value investing and bargain hunting to the intricate world of special situations.
Right.
But there's still more to explore in Chapter 15,
There
right?
is, okay.
Yeah.
In the next part, we'll dive into Graham's analysis
Okay.
of different criteria for selecting stocks
Right.
and what his experiments revealed
Yeah.
about how these factors impact performance.
We're back for the final part of our deep dive into Chapter 15 of The Intelligent Investor.
Right.
So far, we've explored some of Graham's core investing strategies.
Yeah.
From finding those hidden gems, trading below their net current asset value,
Right.
to navigating the complexities of special situations.
Exactly.
I'm curious to hear what else Graham has in store for us in this chapter.
Well, in this last section, Graham gets into some really interesting territory.
Okay.
He starts talking about different criteria for selecting stocks
All right.
and how he tested those criteria to see how they actually impacted performance.
So he was putting his own theories to the test.
He was.
I like that.
Yeah?
What kind of experiments did he conduct?
He used data from the Standard & Poor's stock guide,
Okay.
which we talked about earlier,
Right.
and created hypothetical portfolios of 30 stocks
Right.
based on different factors.
Okay.
He tested things like low price to earnings ratios, high dividend yields,
Okay.
strong financial positions,
Yeah.
even just low price per share.
Interesting.
Then he tracked how those portfolios would have performed over a specific time period.
So it sounds like he was trying to figure out if there were any shortcuts to successful stock picking.
Exactly.
Did he discover any magic formulas?
Not exactly.
Okay.
One of the most interesting findings was that portfolios of randomly chosen stocks, those picked without any specific criteria,
Right.
tended to do quite poorly.
So even if you're not a financial expert,
Right.
just having some kind of plan or framework for selecting stocks can make a big difference.
Absolutely.
Okay.
Another key takeaway
Yeah.
was that portfolios based on higher quality companies, as rated by Standard & Poor's,
Right.
generally performed better
Okay.
than those with lower ratings.
So it seems like quality really does matter,
It does.
even if it might mean paying a slightly higher price for a stock.
Yeah, that's a good point.
Okay, so quality is important.
Uh-huh.
What else?
Well, he also discovered that portfolios of larger companies
Okay.
tended to be more stable than those with smaller companies.
That makes sense.
Yeah.
Larger companies often have more resources to
Yeah.
weather economic storms.
Right. Yes.
Okay, so quality, size, and stability.
Mhm.
Got it.
Yeah.
What else did he learn from these experiments?
Well, this next one might surprise you.
Okay.
He found that portfolios of stocks
Yeah.
with higher prices per share
Mm-hmm.
actually performed relatively well.
Wait a minute.
Uh-huh.
So you're saying that sometimes
Yeah.
those expensive stocks might actually be worth the price?
Sometimes.
That seems to go against the whole bargain hunting philosophy
I know, right?
we've been discussing.
It's definitely counterintuitive.
Yeah.
But what Graham's research suggests
Yeah.
is that sometimes those higher priced stocks
Yeah.
represent companies with strong growth potential
Okay.
or a proven track record of success.
So it's not always about finding the cheapest stock.
Right.
It's about understanding what you're getting for the price.
Exactly.
So it's all about understanding the value behind the price,
Yes.
not just the number itself.
That's a great way to put it.
Did Graham explore this concept of value any further?
He did.
Okay.
He talks about something called the goodwill component of a stock price.
Goodwill component.
Yeah.
Okay.
This is essentially the portion of a stock's price that exceeds its book value.
Interesting.
It represents the market's perception
Okay.
of a company's intangible assets.
So things like brand recognition,
Exactly.
customer loyalty,
Mhm.
strong management team.
Yeah, all of those things.
So it's like the premium that investors are willing to pay
Right.
for a company's reputation and future potential.
Exactly.
Okay.
And what Graham discovered
Yeah.
was that portfolios of companies with a larger goodwill component,
Okay.
especially if they were also large and well-established,
Mm-hmm.
actually performed quite well.
So the market really does reward companies that have built strong brands
It seems that way.
and have a history of success.
It does.
But I can also see how this could be misinterpreted.
Right.
It's not like we should just go out and buy the most expensive stocks.
Oh, of course not.
Okay.
Graham isn't saying to ignore value altogether.
Right.
He's simply highlighting the fact that there are multiple factors to consider
Yeah.
when evaluating a stock.
That's true.
Sometimes those intangible assets,
Mm-hmm.
that goodwill component,
Right.
can be just as valuable as tangible ones.
So it's about finding that balance.
Exactly.
Those companies that have a combination of tangible and intangible value
Yeah,
and are trading at a price that reflects that value.
precisely.
Okay.
And that's what makes Graham's approach so timeless.
It really is.
It's not about chasing fads or trying to time the market.
Right.
It's about developing a deep understanding of how to evaluate businesses and being patient enough to let those investments play out.
It's been fascinating exploring Chapter 15 with you.
It has.
We've covered a lot of ground.
Yeah.
But I think the biggest takeaway for me is that Graham's insights are more than just stock-picking strategies.
Absolutely.
They're a framework for thinking about investing in a more intelligent and disciplined way.
I completely agree.
He's challenging us to be thoughtful investors, not speculators chasing quick profits.
Right.
So to all you enterprising investors out there, remember Graham's wisdom.
Do your research.
Be patient.
And always strive to be intelligent investors.
That's all for this deep dive.
Thanks for listening.
We'll see you next time.